Owning shares of a REIT to get property for 100 years, not a great idea. What if I could buy a product that was never going to obsolesce, that's good for 1,000,000 years? What if it was an indestructible, immortal, incorruptible product? When you buy a Bitcoin, you're buying 1/21 millionth of all the money on the network, or all the money in the world that's ever going to be on that network.
In the world of investing, timing can be crucial. One all too familiar with this is Michael Saylor, who dives into the current landscape of cryptocurrencies, with a major emphasis on where Bitcoin is headed this year. The price of Bitcoin fell sharply and suddenly to start the week, as investors awaited a major Federal Reserve policy decision and digested concerns around Binance. Bitcoin sank to just above $29,000, its lowest level in more than a month. The reason behind the sharpness in the drop is unclear, although the move coincided with recent anxiety from investors around Binance. Specifically, Binance CEO CZ reportedly suggested in private conversation in 2019 that Binance affiliates had accounted for a portion of trading volume around the time it launched its US trading arm. Officials now have questions about whether this activity constituted wash trading aimed at inflating volume. In this recent interview, Saylor discusses Bitcoin as a game-changing investment option and highlights Bitcoin as an asset class devoid of many of the risks found in traditional investments. Bitcoin's finite supply, capped at 21 million coins, sets it apart from fiat currencies, which are subject to inflationary pressures and central bank policies. Saylor believes that Bitcoin will not only revolutionize crypto, but investing across the board. Let's get into the latest interview with Michael Saylor as he discusses Bitcoin's role as the economic epicenter of cyberspace and its potential to revolutionize investing. Don't forget to share your thoughts and comments down below, and leave a like if you enjoy the content we do here.
For the average person, saving money in bonds with a 3.5% or 4% interest rate when the currency expands at 7 or 8, that's a losing proposition. You lose 97% of your wealth over the course of 3 generations. So clearly bonds don't work, right? And savings accounts don't work. So the next question is, do I just put all my excess money in the S&P index? Well, traditionally the money supply in the US is expanding at 7% and the S&P index is going up at 7%. So if you save $1 million over the course of your life and you put it all in the S&P index, then in 100 years, it'll be worth $1 million. So that's wealth preservation, but you're not doing any better than that. And that just kind of assumes that the S&P 500 is going to be relevant for 100 years and you can stick around the country. But it's like treading water. The next issue is, well, so what I put in real estate? If you buy real estate, you're an average person. Can you buy a building? Probably not. Can you buy a warehouse? Not easy. Maybe if you're a rich family, you buy warehouses, right? Rich families buy warehouses, city blocks, and buildings, but the middle class person doesn't. So how do you buy $4,000 worth of a building? Can't. The issue there is your property rights are inferior when you're buying shares of stock or a security versus the underlying property. If you own the building, you can mortgage the building, sell the building, upgrade the building, build 10 floors above the parking lot that the building has. You can develop the building. When you own a share in a REIT that owns the building, like you own 1/100th of the building, you don't have any of those rights. You can't do anything to the building. You're just along for the ride, getting 1/100th of whatever cash flow the general partner decides to distribute to you. And if they make stupid decisions, you're stuck with them. You don't have any property rights. You're inferior in your economic rights. So owning shares of a REIT to get property for 100 years, not a great idea. And that leads us to the problem of securities. What is the problem of security? So you have some money, you invest it in Apple stock or Amazon. The dilutive problem with securities is there are risk factors. First of all, there's a management team. They're going to take 1% every year. They're not doing it for free. They're charging you to manage the company or the building, right? And if you're lucky, that's only 1%. You want to see that in action? Just go look at any ETF. The ETFs charge 90 basis points. If you want to put money into a Bitcoin, BITO or whatever, they'll charge you 90 basis points just as the management fee. So about 1%. What's the cost of 1% over the course of a lifetime? An infinite duration asset, you would basically multiply it by 20, 25. So it means that when I charge you 1% to manage your $1,000,000, I'm taking 20% of your money. I'm taking 20% of all your wealth to charge you 1%. So that's only the first problem. It turns out that when you run a company, you also have the risk of labor, right? Your company may unionize. So you've got labor expenses. And what happens to the equity value when the company unionizes? Well, the union just takes all the profits. And the equity values of those companies start to trend towards zero. So labor is another risk. The third risk is your competitors, right? Your competitor may come up with a better product and you end up like Yahoo squeezed out or AOL squeezed out by Google. Well, then your stock's going to zero, right? I mean, how many companies actually had a competitor? Xerox, Kodak? The world's full of great companies. Where are they today? They end up getting squeezed by competition. The fourth issue is technology. You may just get obsolesced, right? Maybe you own natural gas fields or oil fields and someone creates nuclear power plants and they don't need your oil anymore. Or maybe you sell the world's greatest chemical cameras and people don't need cameras anymore. They have digital cameras. There's always that kind of risk from technology. And then there's execution. Maybe you just don't ship the iPhone 47 to be that good, right? Maybe the iPhone 13 is good and the iPhone 15 is not good, right? And the world's full of examples of that, like Firestone tires or something, and I ship a tire and the tire blows out, and now people stop buying my tire. Or New Coke. Remember New Coke is a product launch that didn't work out well. So when you're investing in a company, you're not just getting a pure investment. You're actually getting an investment in an asset, but you're getting hammered and diluted by force majeure, by bad weather. You might get a war. You might get a tariff or a trade war. Like we just decided to put a tariff of 20% on all Chinese imports. Oops. If you had a factory in China, what happened there? And then maybe you get a real war where someone just impounds your ship or blows up your factory. That happens too. We have real wars all the time. So what's the return on the S&P index? 7% a year. What's the monetary inflation rate? 7%. What's really happening? Well, all these companies, they're just barely holding their wealth. And so what would happen if I got rid of all those risks? What if I could buy a product that was never going to obsolesce, that's good for 1,000,000 years? What if there was no management team and they work for free, right? What if the product is run by computer programs that don't charge a fee? What if there's no labor? What if it's a digital product, so there is no chance to block it via a trade war or destroy it via real war? What if it was an indestructible, immortal, incorruptible product? Well, when you buy a Bitcoin, you're buying 1/21 millionth of all the money on the network, or all the money in the world that's ever going to be on that network. So would you want to own 1/21 millionth of all the money in the world in 10 years, 20 years, 100 years, 1,000 years, 10,000 years? The product's not obsolescing. It's 1/21 millionth of everything. You see, the iPhone will obsolesce. One day you'll be using Apple Vision, or maybe they'll put a telepathic implant in your brain and you won't need phones and you won't need goggles, and maybe you won't need televisions. Those things can obsolesce, but will you want 1/21 millionth of all the energy in the human race? Probably.
Saylor suggests that owning Bitcoin is akin to owning a piece of the world's monetary future. With a fixed supply and an increasing adoption rate, Bitcoin's value can grow significantly over the long term, offering investors a robust store of value and an alternative to the volatility seen in other assets. By highlighting the limitations of traditional investments and the risks associated with conventional securities, Saylor urges investors to consider the benefits of owning a piece of an incorruptible and decentralized monetary network. As the world continues to embrace digitalization and seek alternatives to traditional finance, Bitcoin stands at the forefront, offering an evergreen solution for long-term wealth preservation and growth. With the drawbacks of traditional investments like savings accounts, bonds, real estate, and securities, emphasizing the risks associated, Saylor advocates for Bitcoin as the alternative. What do you think about the latest interview with Michael Saylor? And how do you view Bitcoin's potential to revolutionize the world of investing in crypto? Comment down below. Thanks so much for watching. Don't forget to hit the like button and subscribe for more content just like this. We'll see you in the next video.